Well, hello again, and thank you for coming back. A little bit of housekeeping lessons learned from my last episode. If you're using lav mics, this is a lav mic, and you discover that you can leave it over there on the desk and just turn the gain all the way up on your mic amp and still get a pretty reasonable signal. Let me tell you, that doesn't mean you ought to do it. So that's my long about way of apologizing for some of the sound quality issues on the last video, and I hope this one's coming out a lot cleaner than that. So I promised, well, let's first recover our premise. So what we're covering is the types of tax situations which I watched come through our doors at MCR Accounting, and every other practitioner watches the same thing at this time of year, where my feeling is that if clients better understood the rights that these documents afforded them, they could better prepare themselves for their own tax defense, if you will. So again, I define Terry the taxpayer as being, the standard that we're trying to make everybody equal to, or the CRA is trying to make everybody equal to. Let's say that Terry also has a girlfriend. Terry's girlfriend is Teresa. Teresa the taxpayer she's a T4 earner with a single T4. She makes, let's say, $93,000 a year. And she has one RSP that she manages to contribute about middle of the road. She doesn't max it out every year, but she never fails to get a contribution in there every year. And she is managing to slip a little bit of money into her TFSA because she heard that she could play with tax-free investment earnings if she was able to put some money in her TFSA. So she's excited about that. Teresa is also that standard taxpayer. Okay, so again, not really the topic matter we're talking about. So today, we're going to talk about the person I see as the very first level of not being Terry and Teresa. So let's say this is Teresa's sister. Teresa's sister, Tiffany, lives in Dawson Creek. And because she lives in Dawson Creek, like everybody else that lives in Dawson Creek, she is subject to the T2222 Northern Residency's deductions. So this comes not from anything that Tiffany has done. It is strictly in accordance with the geography of her residence. So there's two types of Northern Residence deductions, prescribed Area A deductions and prescribed Area B deductions. I kind of would assume that most people would know if they were in a prescribed area. But if you've recently just immigrated into the north, then you might want to listen up because you probably are also covered in this, whether anybody's got around to informing you of that at all or not yet. So let's take a look at this. Bring that up over here. Okay, so this is the Northern Residency deduction form for 2020. So the first part, there's several parts to this document, and this is going to be a much simpler, much shorter video than the previous one. So the first thing is, are you in one of the prescribed area? Prescribed area is A, or the area we're in here, and the area Tiffany's in, prescribed area B. Okay? So then that's just simply where do you live, and how much of the year did you live in? Because this is based on a number of days out of the year, as long as it's been 6 consecutive months. Okay, so Zone A, Zone B, both of these have the same divisions, but you'll note that Zone B is precisely half the amount that Zone A is. Okay, so Zone A residents, we actually live quite close to the border. I'm a Zone B resident myself, and so is Tiffany down south in Dawson Creek. But just a little bit north of here on the Alaska Highway, Zone A starts. Okay? So now what this recognizes is people that live in these prescribed areas have certain unavoidable elevated costs of living that really make it so that they cannot be equal to Terry and Teresa as things are. So that's what the T2222 is all about, to bring that into perspective. So we have a much longer active heating season in our area than the majority of Canada. Zone A residents have an even longer active heating season than the majority of Canada. Likewise, produce and goods and all of those things have added costs for residents of the Canadian North. And the government recognizes that, and the CRA recognizes that, and in an effort to bring their tax situation into equality with Terry and Teresa, we have the T2222. So the first part is pretty straightforward. Your basic residency amount, everybody, with a qualification I'm going to get to in just a second, would be entitled to a basic residency amount. There's an additional residency amount. Now, the way this works is in a household, so this form becomes one of the most useful, allowable income, not really income splitting, but income adjusting apparatuses for people that live in prescribed areas at least, that's currently available. There's now income splitting for pensions, and that's been a long time coming, and I'm not by any means complaining about having finally got it, but that's about as far as income splitting really goes. The other really big income splitting opportunity is couples that joint own rental properties. Well, this, for people in prescribed areas, gives you a certain amount of flexibility. So that leads me to the additional residency amount. So a homeowner, a person who rents and maintains or mortgages and maintains a home, is eligible for the additional residency amount. But if that individual claims the additional residency amount, then nobody else in that residency can claim the basic residency amount. I'm not sure whether I'm being clear there or not, but it's going to get clearer here. So how that can be useful for a couple that's filing, for instance, is it may be more useful to put both portions that couple would be eligible for of northern residency, using the additional residency amount, on the higher income, or not even necessarily the higher income, just the income with the less favorable tax picture as you're building up the tax picture for that couple, or that couple might be doing it for themselves. But let's say this isn't a couple. Let's say this is a home owned by an individual who is subletting it to 3 other individuals. If that individual, and this would often be the case, is claiming both of those amounts, that's why he's subletting his house in the first place, is trying to look after his own self, then the other residents in that home wouldn't be getting a residency amount. So, what if the 4 of them are all co-renters? In that case, nobody would claim the additional residency amount, and all 4 residents in that home would qualify for a basic residency amount. So I know I kind of mixed that up, 2 different things. On one end, I was dealing with the light tax picture splitting or adjusting you can do with a couple, and on the other hand, I was talking about how this affects multiple people living in a home. So if one person, to clarify, in the home is claiming both the basic and the additional residency amount, that's it for the home. If nobody is claiming the additional residency amount, then each tax filer in that home can file with the basic residency amount. So we even see this sometimes. Sometimes mom and dad have adult working children, single children. They have no reason to move on, and so they're still living at home. And I've seen the situation where the parents choose to drop the additional residency amount so that their younger wage earner can start, picking up some of those credits. So that's the flexibility there. Up until this point on this form, there isn't, sometimes there's a little bit of confusion about how the additional residency amount works, but where the confusion begins with this form is when we come down to the travel allowance. So let's talk about some history here to start with. If you were wanting to hire, red sealed tradespeople at, a facility in Taylor, BC, down the street here. Say you wanted an electrician, and it's a union job, and so you're paying union rates. And here's the thing, is union rates in Kelowna and union rates in Taylor are going to be the same. So there wasn't a great deal of flexibility there. So what a lot of collective agreements, and this goes way back before my time, created, like a stipend, a northern living allowance is what it used to be called when I worked in the collective agreement. It was actually part of our negotiated settlement, and it was in addition to our wage settlement. So our wages were in line with the union, the national union standards, but we had this additional amount through the northern residency amount. That amount, let's face it, companies were using that to lure people to them when their actual hourly rate would be precisely the same as where they live. So that's kind of the history of where what we're now going to refer to as Box 32 travel allowances came from. Now, since that time, it has also become fairly common in prescribed areas for employers to, it's sort of a favor to the employees in a way. They take a portion of the employee's wage and reassign it as northern living allowance to the Box 32. And more often than not, those end up being more realistic numbers. I'm gonna walk you through what I'm talking about there in a second here, but those aren't additions to your wages. So then they're just shuffling your wages from one to the other, was the only thing I was trying to say. So there's two different ways that it shows up. The most important part is if you do not have a Box 32, whether you live in a prescribed area or not, and this, whether it's a B area or an A area, if you do not have a Box 32, you're not going to be placing a claim in this area, right? This is purely for the Box 32 allowances. You're paid an extra allowance for having lived in the north, and the CRA is recognizing it, and they recognize it as a travel allowance. Okay, so let's cover what we mean by travel allowance. We do not mean that the government or employers or anybody in the world believes that just because you live in a prescribed area, you should get a tax-free trip to Hawaii every year. That's not what this is for. Again, let's go back to the concepts we've been talking about. The concept of equality with Terry and Teresa. So as it turns out, Teresa could, if she was super ambitious, literally walk to the international airport that she lives closest to. Well, Tiffany, I suppose, depends how, I don't know Tiffany's physical fitness level, but Assumingly, she probably could walk to an international airport, but it would take a good long time, and most likely her vacation time would be up before she would make it there. That is all that Northern Travel was ever meant to do, to get us into the same, destination launch position, not destination, in destination launch position as Terry and Teresa, right? So it's very important. People are very much misunderstanding what part of their travel allowance, what their travel allowance is actually going to cover, okay? And it was important that I explain that before I start showing you how this thing works, because that's the next thing people don't understand really. So typically, you would be filling this out after you've got your T4s and everything in there, and this number here will self-populate like we talked about. See, it's a blued in number, so it's going to say something in there, and I'm going to transcribe that number down to here right when I start. So let's say that says $5,400, okay? That is the amount of money that Tiffany has in her box 32, okay? And Tiffany's going to be going on a vacation from a B prescribed area, right? And the purpose of her trip will be a vacation, okay? And we've worked out, the cost of her trip. So this is going to be Tiffany and her, well, first we're just going to do it with Tiffany. So Tiffany's actual vacation cost was $6,000. Back that up one, okay? However, remember what I said. It is not intended that Tiffany gets a tax-free vacation. It is intended that that portion of her travel out of Dawson Creek to get to where she can launch to a vacation, let's say she's going to Hawaii, let's stick with that for consistency's sake, to make her equal to her sister, Teresa, who can walk to the international airport. So currently in our area, there's two ways you can go about this. On the day you leave, you can document by getting a hard quote the lowest airfare, in Tiffany's case, the lowest airfare out of Dawson Creek to get her to the international airport where her flight to Hawaii is going to leave from. That's one thing. And she can keep that documentation for when she tax files, or she can bring that documentation into her tax preparer when she files her taxes. If not, then the CRA also every year, not just the CRA, the tax professionals. What this number then, the other number you can use here is what's the accepted reasonable average rate. So what we've been using for this year is 525. Okay, so let's scroll down the form and see what happened here. And because this is where misunderstanding starts. So Tiffany knows that she has $5,400 in Northern Travel allowance. Okay? And she went on a $6,000 trip. It's in her mind that when she gets down here, she's going to see a total claimable benefit of $5,400, but she's not. As you can see, she is actually going to see the lower of these two numbers. Okay? However, what happens if Tiffany has a spouse who goes with her on this vacation? Okay? Well, the first thing to understand is the way that we do that. And the way we do that is we take the 5,400 that we have on the first line, right? And then we take the amount that we were allowed, the 525, and we subtract it, and then that gives us the amount allowable for here. So now we got 4875. Okay, the 6,000, they went on the trip together, so that's going to change. Now there was two people, but let's say they spent the exact same amount. Okay? It's, maybe Tiffany's tastes were a lot higher before she had a spouse than they are now. But let's say it was still a $6,000 holiday, but that ends up being $3,000 per individual on the holiday. Okay? So then we take that same $3,000 down to here. Okay? And then again, the lowest airfare rate doesn't change between the two of them. But look what we have done now, right? When we scroll down. Now, because two of them went on the vacation, now Tiffany will get $1,050 credited back out of this $5,400. Okay? And so on, and so let's say that they have a child, right? And now it used to be when I was young, parents typically didn't necessarily take their kids on vacation. But nowadays, I hardly know anybody that goes to Hawaii and doesn't take their kids with them. So then we take that same 525 again and subtract it out again. That gives us 4350, right, as an allowable. And let's correct now. Let's say it's still a $6,000 vacation. We're getting to be better and better shoppers as our family grows. Most of us do. So at one time, Tiffany would spend $6,000 on herself, and then they were spending $6,000 a couple. Now they're spending the $6,000, but they have a child. Okay, so that's now turning it into a $2,000 credit. We'll just go up and correct these. Okay, and again, let's put the lowest airfare in. So now, don't let anybody ever tell you that there's no further value in having children. Because if we can figure out how to get this thing to scroll, now we got $1,575. Okay, and so on and so forth. You can clearly see that if you have a really big number in your box 32, the only way you're going to really use it up is if you have, a couple of children that you take with you on these vacations. So, good for the kids. It's a good incentive. The reason some of these numbers are completely out of line with what the benefit actually is, and that's kind of what I'm calling out here, is do not get the idea that just because your T4 says, and I've seen numbers like $12,500 in here, okay? How that comes about, and those kind of numbers come from gigs like I used to work in, where it's part of the collective agreement. And year on year, for as many years as it's been there, when a percentage wage negotiation is negotiated, often side benefits like the Northern Living Allowance were brought along for the ride. More often than not, were brought along for the ride. So now those benefits, like the Northern Living Allowance that I used to get when I worked in industry, that number is slowly gone up and up and up over the years, and it has become a number that is quite out of line with what the actual benefit is. That's not a big deal. I mean, because we're talking about two different things. That's a negotiated benefit that the company has negotiated with the collective bargaining unit in order to help lure workforce, right? Because again, these people are union workers, and union workers can make the same money, living in a place where you can drive to a lake that isn't frozen 6 feet solid, right? So that makes quite a lot of difference to people, and so that's what these incentive packages were meant for. And it's also the more or less the same thing that the CRA and the government intended with the Northern Residency deduction in the first place, to make it possible to live in the areas we call prescribed northern areas without being hugely financially disadvantaged over your peers, Terry and Teresa. So I hope I've made that a little bit more clear for people. It's not as complex as the topic that we took on yesterday, but it is still a big confusion, almost solely in the area trips. So I'd say probably 45% or 50% even of our clients in a prescribed area do not have a box 32, right? And they're then only dealing with that, they're only dealing with that other part that everybody, the planar part, okay, where the only issue is whether or not you take both the additional and the basic, or everybody gets their basic, okay? This is only for people with a box 32, and this is one of the biggest areas of confusion. It isn't that you get this $5,400 that you see in your box 32 and you deduct it from your earnings. That's not how it works. This is the correct way. I'm showing you the correct way to fill out one of these forms. I know that it's not the way everybody does it. So, and I'm happy to dialogue with anybody in email anyway. But you can write to me about it if you want. I recognize that other people are doing it differently, and I know that other tax preparers are also doing this slightly differently. But I assure you, this is the actual correct way to fill out this form. And when you do things the actual correct way, you spend way less of your time re-explaining yourself in reassessment. Okay, and that also is a part of what I'm hoping to help you get to. That, you know, if you're gonna do these things yourself, you're gonna hope to get to a lower assessment level. So, thank you for coming by. I hope this has been helpful to you. The next two forms I want to deal with are considerably more complex, and it's probably going to take me a while to get that one out. So the next one we're going to take a look at is Form 2125, Statement of Business Activities. And there's a lot of ins and outs on that one. Who knows, I might even end up having to break it into a two-part. Thanks so much for your time. Please do have a nice day.